The run on gold has only just begun. End of US dollar hegemony leaves vacuum for flight to safety. This is Fergus Hodgson, Director of Econ Americas. The gold bugs among us were rewarded this year with a 20% spike in price in March and April. Since then, however, there has been sideways jostling between support and resistance at US 2,300 and 2,400 per ounce. That poses the question, has gold's spike settled on a new plateau, or is there more to come in the next 12 months? While no one can predict the future with precision, there are fundamental reasons why the flight to gold and mining stocks is just getting started, and the 20% bump will look like small potatoes. Chief among those reasons is the demise of the US dollar and other major currencies as havens for safety. Get ahead of the curve. Brian London, publisher of Gold Newsletter out of Louisiana, is one of my go-to men on precious metals, with experience dating back to work with the late Jim Blanchard in the 1980s. London's first lesson is that you have to accept immense cyclicality in the mining sector. Financial market herd behavior, excitement begetting more excitement, and fear of missing out muddies the price and the task of forecasting. We have yet to see a stampede from retail investors towards gold and gold-adjacent stocks this year, not even close. Few North Americans seem to have noticed the bump, perhaps because it stemmed from foreign buyers. As London noted in April, quote, "I was at a family Easter gathering over the weekend with 75 people who know what I do for a living. Not one question or comment on gold. This is great," unquote. Great if you wish to see a rise to come. The level of interest is primed to change as the United States enters recession. On a per capita basis, Canada is already there, and that spells a desire for real assets amid stormy weather. Mining-oriented portfolio manager Adrian Day, writing in Global Analyst, explains that, quote, "When broad buying from smaller institutions and retail comes into the sector, the moves in mining stocks could be explosive," unquote. For mining stock recommendations, one newsletter I read is Global Analyst by Adrian Day, and I'm more than pleased to recommend him to other people. Receive a 10% discount when you subscribe over the phone with the code FERG or FERG. The US number is 410-224-8885. That's 410-224-8885. Barriers to supply. If we step back, we observe two pivotal factors driving more costly supply and ensuring that demand translates into higher prices. First, less accessible resources, and second, regulatory and social impediments to mining. In the case of the former, a fixed supply of gold in the ground means higher marginal costs after the low-hanging fruit is taken first. With each year that passes, the task of finding and extracting gold becomes more isolated and difficult. Exploration companies are prying into all remote corners of the globe, from Guyana to Canada's Arctic regions. Regarding impediments, this is not a secret. Regulatory requirements continue to grow more onerous and less predictable. From the identification of a resource to its extraction can easily take a decade, largely on account of permitting hoops to jump through, and that is in the supposedly business-friendly United States. The Fraser Institute in Vancouver notes, quote, "Uncertainty surrounding protected areas, land claims disputes, and environmental regulations continues to hinder mining investment in various Canadian jurisdictions. Mineral deposits alone are not enough to attract investment," unquote. In March, the British Columbian government simply paused all exploration, mining, and permitting in two regions. And you can bet other areas will suffer the same fate. Activists have also realized they can use violence to shake down mining companies and intimidate politicians. The Cobre mine in Panama is a recent example of a major project that succumbed to intimidation, costing TSXV-listed First Quantum Minerals and the tax collector tremendous sums. 40% of FQM's market capitalization and 5% of Panama's GDP. The conclusion is that gold supply is tightly constrained with lengthy bottlenecks and high and unpredictable surge costs. There is little way to respond quickly to meet increased demand. That means when increased demand occurs, it has to be almost entirely dissipated by higher prices. The key driver of demand. Something changed during the global financial crisis of 2007 to 2008. US hegemonic dominance of international affairs came to an end. That all but sealed the fate of the US dollar. Its days as the world's reserve currency and haven for safety were numbered. Adrian Day's 2010 book, Investing in Resources, noted that, quote, the US dollar is a fundamentally weak currency with high budget and trade deficits. Over time, such deficits lead to weaker economies, unquote. Day foresaw the Federal Reserve sacrificing the US dollar's value by easy money to win political points. The predictable outcome of higher inflation, lower US dollar purchasing power, has come to pass, as it has with the loonie in Canada. Further, higher reported inflation rates, sitting at 3% officially, appear to be a permanent fixture for both nations. There are a variety of reasons for holding gold, including industrial uses and jewelry. China's burgeoning economy and need for industrial supplies is a piece of this puzzle. However, the main driver of fluctuating demand for gold is the pursuit of a store of value safe haven. The relationship between gold's value and inflation is not one-to-one, but eventually they have a habit of catching up to one another. So far this year, foreign central banks and ultra-high net worth individuals appear to have led the heightened interest in gold as a safe haven. I see no reason why this affinity will not spread to institutional investors and finally to retail investors. If we look at history in real inflation-adjusted terms, gold is still below its 1980 peak, and that was when Pax Americana reigned. Two Dutch researchers published an analysis with the CFA Institute early in 2021 that foresaw $3,000 gold within the next couple of years. Given 3 years of inflationary buildup, their analysis is even more compelling now. At the very least, it suggests little downside risk. The key takeaway is that those looking for asset protection, a safe haven, will increasingly realize that Canadian and US dollar-denominated bonds no longer offer that. Maybe the Swiss franc is one currency that does, but relatively speaking, gold is rising as the go-to for flight safety. That can manifest in physical possession, vault storage, or investments in senior miners or streaming companies for dividends and upside potential, but the underlying logic is the same. Chapter 20 of my book, Financial Sovereignty for Canadians, a gold primer fit for our times, addresses how to build a precious metals portfolio. Please share your comments below and subscribe to Econ Americas on Substack and YouTube. You can also contact us for financial consulting services. Learn more at econamericas.com. Thank you for listening.